Barry Sternlicht is the chairman and CEO of Starwood Capital. And Barry, I'm sure you've seen the letter. Jamie makes comments about how the odds of a recession are even higher now. You could be looking at this banking crisis continuing, not knowing when it ends. But he also said that inflation could be much more stubborn than people realize, and that could force the Fed to raise rates even higher than people are anticipating. What would you say to that?
First, I'm a huge fan of Jamie's. So, he runs probably one of the best banks in the world, and he's been an amazing steward of shareholder value. We don't agree on everything. I agree on the recession, as you know from my last appearance. And I think inflation is going to drop hard. And there's a CPI slide that I brought with me that shows why. It is about the rent component of CPI. And food is already dropping, and energy was dropping. Energy is a wild card. You can't actually model what the Saudis just did, right? If they choose to keep energy prices high, and inflation could be a little more stubborn.
You brought an actual slide.
I did bring a slide.
You brought a slide?
Yeah, I brought
like a statement.
A whole three. There you go.
There it is.
So this is really important. The blue line is actual rents, and the orange line is what the government is reporting. And you can see last month, actually, rents were up 0.8, which is almost a 10% rise in rates. And in fact, rents are falling. If you correct for this, and there's a lag in the way the government reports rental data, and this is 1/3 of CPI, it's 33% of CPI. If you just make the correction of +10, which is what they're reporting, to +4, which is what the nation is seeing, it'll take headline inflation from 4.3 to 2.6. Just that one correction. You will see this in it's probably late summer and the first month of the fall. So all else being equal, inflation's going down. The PPI is down. You're seeing lots of things coming down. Wage growth is slowing. I mean, this isn't a bull market.
Where's the actual rent data come from?
That rent data?
Yeah.
It's a national database, but we have 125,000 apartments. We can model it. It's not even across the country. If you go to Florida, South Florida rents are up 10%. You go to Austin, they're down 4%. Denver's down 4%. There are actually places where they're going down. All over California, rents are falling. Actually, double digits. So in apartments. So the way they do that the survey of households is somewhat archaic. I mean, they started this survey 50 years ago, 1981, before they had the internet. And they've updated it 3 or 4 times, but it's not the way they could go right online to apartments.com and pick up actual rents that people are charging. They call homeowners and ask people what they could rent their house for. And if the government calls me, I'm hanging up the phone. I'm not telling them what my house could rent for.
We saw those lines. Eventually, they get back to there's a lagged effect.
But can you put that?
Do you expect 2 or 3 months?
Can you put the chart up?
Actually shows up in the CPI numbers.
No, like 4 to 6 months. And can you put the chart up for a second again? What you'll see is what the Fed missed was when rates were going crazy in 21, their data didn't show it. So while we thought inflation was through the moon and beyond, they said, we'll keep rates low because there's no inflation, it's transitory. It wasn't transitory. That was 100% the result of all the stimulus packages. That was flush consumers coming back to the cities, and rents rose everywhere. New York, Peoria, Dallas, everywhere. It was Albany. I was in shock, and they were up 20%. And so that is what really drove CPI for 5 months in a row.
By the way, I will give you credit for saying at the time you thought they needed to raise rates sooner.
Right. Yes. And they did. I don't know why the Fed has such credibility today when they really are.
They don't have
I saw Neon yesterday.
Do the markets give them any credibility?
No, so I think Jamie's wrong. I think we're going into a serious recession, and the government has an interesting problem, but not for the reasons he stated. They have a massive deficit, and they keep feeding the deficit. That forces rates higher because too much supply of paper to pay for the deficit. Receipts are going down because capital gains are going away. Real estate, as we'll talk as a complex, values are down. So with interest rates up, values are down.
Well, that's the one thing I would say.
So receipts are going down, and interest expense is going up. He's going to have to, the deficit will grow. He'll have to print more paper. That should force rates up, which would make the economy weaken further. So he's going to have the opposite problem. He's going to have rates going up and the economy weakening, and he's going to have to lower.